Okay, so, it feels like every time we turn around, the market's taken another dip.
Yeah, another one.
And, if you've got, any kind of investment portfolio at all, and you've seen a little bit more red lately than you'd like, maybe felt a little flutter in your chest, you're not alone.
It's definitely a natural reaction, I think. We see these headlines about, sticky inflation and the market's just not quite sure what to make of it all. So we see a lot of volatility.
Right. Yeah, I mean, it's the market being a drama queen as usual.
Yeah, pretty much.
But you know what? If instead of looking at this as, kind of a scary time, what if we looked at it as an opportunity? And specifically an opportunity for those of us who are interested in, high-yield dividend stocks.
Absolutely. I think that's, a really important point to make is that when we see these dips, it's not all doom and gloom. In
Right.
fact, for certain types of investors, it can be a very attractive time to, either initiate a position or add to an existing position.
Right, because, basic math. The price goes down, the yield goes up. And so that's kind of, what we're going to dive into today.
Right.
So we're looking at some sources here about high-yield dividend stocks.
Mm-hmm.
And, specifically what we're looking for is, those yields that are kicking off somewhere between 6 and 10%, that might have a little bit more resilience if the market, continues to be a little bit bumpy.
Yeah, absolutely.
So let's dive in. So, one of the things that I'm seeing in some of these sources is that, first of all, like we got to reframe how we think about market dips,
Right.
right? Because they're not always a bad thing.
No, they're not. They're actually part of a, healthy market cycle. I think, we get so caught up in, the day-to-day movements that we forget that the market, is always going to ebb and flow.
Right. And it really is like that Warren Buffett quote,
Yeah.
be greedy when others are fearful.
Yeah.
And it's,
yeah.
it's the people who can kind of separate their emotions from, the fundamentals who are going to be able to capitalize on these opportunities.
Yeah, for sure. I think, a lot of people, when they see that, price drop, they kind of, panic and they sell and, they're missing out on a really great opportunity.
Right. And it's so funny, too, because it's like, the tech bros are like, okay, this is the time to buy the dip, right? And the meme stock gamblers are like, this is the time to buy the dip. And it's like, well, maybe for dividend investors, this is the time to buy the dip, too.
Absolutely. They're looking at different things, but yeah, you're right.
So okay, the idea of buying the dip when it comes to dividends makes sense. But, there are some things that we need to know before we just go out and, buy any stock that's got a big juicy yield attached to it.
Right. And one of the most important things I think to remember is that, you need to do your due diligence. A high dividend yield isn't necessarily a good thing. It can actually be a red flag.
The value trap.
Exactly.
Which is, it looks good on the surface, but then, you dig a little deeper and it's like, oh, this company's not doing so hot.
Right.
So what are some of the things that we should be looking at, when we're evaluating a dividend stock?
Well, the first thing I would say is look at the company's free cash flow. Free cash flow is basically the cash that a company has left over after it's paid all of its operating expenses.
Okay.
So it's the money that they have to, reinvest in the business or pay dividends.
So if they don't have a lot of free cash flow, it means that they may not be able to sustain that dividend.
Exactly.
Okay, so free cash flow.
Then I would look at the payout ratio. The payout ratio is the percentage of earnings that a company pays out in dividends.
Okay.
So a high payout ratio means that a company is paying out a large percentage of its earnings, which could be a sign that the dividend is not sustainable.
Okay, so lower payout ratio is generally better?
Yeah, I would say so. Yeah. And then I would also look at the company's business model. You want to make sure that the company has a sustainable business model that's going to be able to generate cash flow for years to come.
Right, so is this a company that's, selling buggy whips?
Yeah.
Or is this a company that's, got a product or service that's going to be in demand for a long time?
Exactly.
So,
and then finally, I would look at the management team. You want to make sure that the management team is competent and trustworthy and that they have a track record of making good decisions.
yeah, our source even uses the term, watch out for walking red flags,
Exactly.
with the management team.
Yeah.
So if you're seeing stuff that's, making you scratch your head, maybe that's a sign to stay away.
Right. Yeah. Trust your gut on that one.
Okay, so let's get into some specifics here because our source has highlighted a bunch of stocks that might be worth a closer look. Let's start with Altria Group, ticker symbol MO.
Mm-hmm.
And, this one's interesting because it's yielding about 9.3%.
Wow, that is high.
It is high.
That's pretty juicy.
It is juicy. And, Altria is kind of, the king of sin stocks, as they call it.
Right.
And there are a lot of us who just won't touch it. because, they don't want to be involved in tobacco.
Sure. Yeah. Ethical considerations for sure.
Absolutely. But, purely from a financial perspective, this is what they call a dividend fortress.
Yeah, it really is. And I think, a lot of that has to do with the addictive nature of nicotine.
Right.
People who smoke, they tend to keep smoking.
They're going to buy their cigarettes.
They are.
Yeah.
And Altria has a lot of pricing power, so they can raise prices and people are still going to buy their products.
Right. And, their payout ratio is pretty high. It's 77%. But they've got a ton of free cash flow.
Exactly.
So it's like they're covering it and then some.
Yeah.
And then, the other interesting thing about Altria is that they're not just a cigarette company anymore. They're also getting into vaping and cannabis and all these other, vice sectors, as our source calls them.
Interesting. It's just like they're diversifying their sin.
They are. They're diversifying their sin. So, it's definitely a company to watch. And, I think it's one that, if you can get past the ethical concerns, there might be some opportunity there.
Yeah, for sure.
Okay, so let's move on to a completely different kind of company. This is Enterprise Products Partners, ticker symbol EPD, and it's yielding about 7.1%.
Okay, a little bit lower, but still very respectable.
Right, and the funny thing about this company is that our source calls it a boring old pipeline company.
Oh, okay. Yeah, I can see that.
Right, it's not, it's not Tesla, it's not, some whiz-bang tech company, but, for dividend investors, boring can be beautiful.
Absolutely. I think, when you're looking for consistent income, boring is definitely a plus.
Right. So basically what this company does is it owns and operates pipelines and storage facilities and processing plants for oil and natural gas. So basically they're like the toll roads of the energy industry.
Yeah, that's a great analogy. I think our source even calls it like an easy pass for fossil fuels.
Exactly.
So, no matter what the price of oil or gas is doing, they're still collecting those tolls.
Right. So the earnings are a lot more stable.
Right. And predictable.
Than, a company that's actually, producing the oil or gas. And, they've got a great track record. They've been increasing their dividend for over 25 years.
Wow.
And their debt levels are reasonable.
Yeah.
So, this is another one that's, maybe not going to set the world on fire, but it could be a nice, solid addition to a dividend portfolio.
That sounds like it. Yeah.
Okay, so let's move on to Verizon, ticker symbol VZ, yielding about 6.8%. And this is a company that I think a lot of people are familiar with, but our source mentions that, their stock price chart looks like it took the stairs down.
Oof.
Okay, not great.
Not great for growth investors, but, for dividend investors, it might be a different story.
Right, because again, it comes back to that yield.
Right.
And if the company is still solid and generating cash flow, then that yield could be very attractive.
Right. So Verizon, they're a telecom giant. They've got a massive customer base, and people need their phones and their internet.
It's true. I mean, I can't live without my phone.
Right, exactly. So even in a recession, people are probably not going to cancel their phone service.
Probably not. All right, so it's a pretty recession-resistant business model.
Yeah, for sure.
And, they're covering their dividend. Their valuation is really attractive. The source even uses the term dirt cheap.
Okay, so it sounds like there could be some value there.
Yeah, the downside is that, growth is slow, and they've got a lot of investment that they need to make in 5G.
Right. So it's not without its risks.
No, but, the idea here is that you're getting paid to wait.
I like that.
Right, you're collecting that nice dividend while they kind of, figure out the future of their business.
It makes sense.
Okay, moving on. We've got another player in the midstream energy space. This is MPLX LP, ticker symbol, MPLX. And this one's yielding about 9.2%.
Wow, okay, back up to the high yields.
Yeah. Yeah. So basically this company is a spinoff from Marathon Petroleum, and they're basically doing the same kind of thing as Enterprise Products Partners. They're just a little bit smaller.
Okay.
And so, they've got strong distributable cash flow, which is basically the equivalent of free cash flow for MLPs. And they're covering their dividend. They've got long-term contracts, and they've been increasing their payouts regularly. So, it's another one that's, if you like Enterprise Products Partners, you might like MPLX as well.
Yeah, it sounds like a similar kind of business.
The one caveat with this one is that it's an MLP, which means that it's got a kind of weird tax structure.
Okay, so investors need to be aware of that.
Yeah, you're going to get a K-1 instead of a 1099.
Right, which can be a little bit more complicated.
So definitely something to be aware of.
For sure.
Okay, so let's move on to a potentially riskier option.
Yeah.
This is AGNC Investment Corp, ticker symbol AGNC. And this one is yielding a whopping 14.1%.
Wow, 14%. That's huge.
It is huge. And, our source even uses the term hold your nose territory.
Okay, so definitely some risk involved here.
Right. So basically, this company is a mortgage REIT,
Right.
which means that they invest in mortgages.
Okay.
And they use a lot of leverage, which means that they borrow money to amplify their returns.
Okay, so if things go well, they can make a lot of money, but if things go bad, they can lose a lot of money.
Exactly. And,
Yeah.
they have cut their dividend in the past, so it's not like it's a sure thing.
Right.
But, the potential upside here is that if interest rates peak or start to fall, AGNC could benefit.
Okay, so it's kind of a bet on the direction of interest rates.
Exactly.
Okay.
So, it's definitely not for the faint of heart.
Right.
But, if you're looking for a high yield and you're willing to take on some risk, it might be worth a look.
Yeah, I could see that.
Okay, so let's move on to Ares Capital, ticker symbol ARCC, yielding about 9.6%. And this one's interesting because it's a BDC,
The BDC, what's that stand for?
a business development company.
Okay.
And basically what they do is they lend money to mid-sized companies.
Okay, so kind of like a bank?
Yeah, kind of like a bank, but they're not regulated like a bank.
Interesting.
And so Ares Capital is one of the biggest and best regarded BDCs out there. They've got a really diversified loan portfolio and a really good management team.
Okay, that
Yep.
sounds promising.
Yeah, and their dividend is well covered.
Great.
So, it's definitely a riskier asset class than, like a Verizon or an Altria.
Right, because you're lending money to companies that might not be able to pay you back.
Right, exactly. So, you got to be aware of that risk. But, if you're looking for a high yield and you want to get exposure to, kind of the private credit market,
Right.
Ares Capital might be a good way to do it.
Interesting.
Okay, so finally, let's talk about British American Tobacco, ticker symbol BTI, yielding about 9.1%.
Okay, another high yielder.
Yeah, and so basically this is Altria's posh British cousin,
Okay.
right? They're a global tobacco company, and they're basically doing the same thing as Altria. They're just doing it on a much bigger scale.
Okay.
And so, they're trading at a really low valuation. They've got massive cash flow, and they've got the potential to grow their dividend.
Sounds good.
The one thing to keep in mind with this one is that their dividend is paid in pounds.
Okay, so you've got some currency risk to think about.
Right, exactly.
Hmm.
But, other than that, it's another one that, if you like Altria, you might like British American Tobacco.
For sure.
So, okay, we've looked at a lot of different high-yield stocks here across a bunch of different sectors.
Mm-hmm.
What is it about this particular moment in time that makes, this strategy potentially attractive?
Well, I think, one of the things that we're seeing is that a lot of these companies have what you might call inflation-resistant cash flow.
Okay.
So, even though inflation is high, they're able to raise prices and maintain their profitability.
Right, so they're not getting squeezed.
Exactly.
Right.
And then I think the other thing is that, a lot of these companies have what you might call defensive business models.
Yeah.
So, even if the economy slows down, people are still going to need to buy their products or services.
Right, so people got to heat their homes, they got to drive their cars, they got to have their phones.
Right, exactly.
So those businesses tend to do okay even in a recession. And then, the other thing is that, we are seeing some attractive entry points because the market is down.
Right.
So, if you're a long-term investor, this might be a good time to, start nibbling at some of these stocks.
Yeah, for sure.
Okay, so our source also mentions a bonus tip, which is using dividend reinvestment plans or DREPs
DREPs.
during a market downturn.
Okay.
So can you explain what a DREP is and why it might be a good idea right now?
Yeah, so a DREP is basically a program that allows you to automatically reinvest your dividends back into the stock that paid them.
Okay.
So instead of getting a cash payment, you get more shares of the stock.
Okay.
And the benefit of doing this during a market downturn is that you're buying shares at a lower price.
Right. So you're dollar cost averaging.
Exactly.
Our source call him being the dividend Thanos.
I love that.
You're just collecting all those dividend stones.
Sick.
Okay. So, of course, no investment is without risk. So what are some of the things that could go wrong with this high yield dividend strategy?
Well, I think, one of the biggest risks is that the economy could slow down more than expected.
Okay.
And that could lead to some of these companies cutting their dividends.
Right.
Another risk is that interest rates could stay high for longer than expected.
Okay.
Which could make it more expensive for these companies to borrow money.
Right.
And then there's also the risk of regulatory changes, specifically for some of these sectors like tobacco and energy.
Right, like the government could crack down on them.
Exactly.
Okay. So it's not a risk-free strategy, but, it's one that I think, if you're careful and you do your research, it could be a good way to, generate some income and potentially grow your portfolio over the long term.
I agree.
So to sum it all up,
Yeah.
the market is down, which can be scary, but it can also create opportunities. And one opportunity is to look at high-yield dividend stocks.
Right.
We've talked about a bunch of different companies today: Altria Enterprise Products, Partners, Verizon, MPLX, AG&C, Ayers, Capital, British American Tobacco.
A lot of options.
A lot of options. And, this is just a starting point.
Right.
We encourage you to do your own research, dig a little deeper, and see if any of these companies might be a good fit for your portfolio.
I think that's great advice.
And, the other thing to keep in mind is that, investing is a long game.
It is.
So, don't get too caught up in the day-to-day fluctuations.
Right.
Focus on the long term and, try to build a portfolio that's going to generate income and grow over time.
Absolutely.
So, thanks for joining us for this deep dive into high-yield dividend stocks, and, see you next time.
See you later.
Bye.